Ontario Teachers' Pension Plan is one of the world's largest and most influential institutional investors, managing nearly $200 billion in assets globally. Their investments in India stand at over $4 billion and are growing, with a diversified portfolio that spans infrastructure, private equity, real estate and tech. Ontario Teachers is known for its long-term patient capital and disciplined investment approach. Today, I have the pleasure of sitting down with Ontario Teachers' CEO, Joe Taylor. Joe, welcome to the program. Thank you very much.
Thank you for having me.
For markets globally, it has been a time of change, some confusion, but lots of opportunities ahead as well. So with that short preamble, let me dive straight in. Joe, once again, how are you liking your Mumbai trip so far?
It's always nice to come here. I find the optimism in India really encouraging, and there's good reason to be optimistic. Lots of good things happening in the country.
Although right now, a lot of the focus is on what's coming next week, 2nd April, Trump tariffs, reciprocal tariffs day, or as President Trump has been calling it, Liberation Day for the US. I mean, as a patient, long-term investor, Joe, how are you thinking about this? Do you think, do you go with the this too shall pass attitude, or you think it'll do some durable damage?
We're probably a bit in the middle. So we are a very long-term investor. You know, our liabilities go out 40, 50 years. So
right.
The first thing you want to do is not overcompensate. And some of the impacts of the tariffs isn't really fully understood yet. Second thing to say is we try to plan to have a very diversified portfolio, both in terms of the asset classes we hold and actually where we hold it around the world. So really what we're trying to do always is to be agile, but also to be thoughtful about what we might want to bring in as new investment activity and where we probably feel a little bit more exposed. But coming back to the US, we probably have around 30 billion of investment there. So it's a material market for us, and it's also been a very profitable market for us over 20, 30 years.
You said I don't want to overcompensate, but is there a risk of underpricing the risk?
Well, our job's not to do that. You know, we do take risk and we're willing to do it. We're a mature plan, so we have to be careful. Our contributions out exceed our payments in every year. But what I think I would say is that you can overreact sometimes to news flow and things that look like they could be a material impact on your activities without really fully thinking through how it's going to land. I think we're honestly still in that mode of still trying to evaluate what to do. But certainly, if you're based in Canada at the moment, there's a lot of reflection. We've got an election coming up. We've also got quite a few initiatives that have been developed about how we continue to invest in Canada ourselves, but also how do we help trade where it may be going less into the US than it did before. You know, you sit on top of one of the largest sort of institutional investing assets globally. My question is, which way are you leaning? Do you think this will be a bit of a break from the past, what is being proposed, you know, America first, tariffs, and it looks like they really believe in it. It's not like a negotiating tool and then you sort of propose something and walk back all of it. We will find out. But without going into specifics, do you think it's, on many fronts, not just from a market standpoint, it's a bit of a break from what we've had so far for a few decades, actually? It does feel something different. We're actually trying to plan for something that is enduring, because that's the easiest way to be sure of probably the one with the biggest implications for an investor like ourselves. The thing I would stress is, and you did it in your introduction, so thank you for doing it, is, you know, we are an international investor.
Yeah.
We do look to try and have a diversified portfolio around the world. That's why I'm here in India. That's why we have a team on the ground here. And sort of my job is really to say, if it gets a little bit more tricky in some markets or some asset categories, what do we do? And that agility and that willingness to innovate and try some other things out has really stood teachers out for a little while.
The other, you know, so for example, America first.
Yes.
Making in the US has been a big sort of theme. We got this 25% auto tariffs on cars not made in the US, right? I mean, that's just one example. What about capital itself? Will capital allocation strategies change because of what is happening? You know, US versus the rest of the world. I mean, actually, in many ways, US has been the only game in town for the last few years. Will that continue to be the game in town, or you think, how are you thinking about the whole thing?
Sure. Well, it is an attractive market. If you look around the world and you look at the risk-adjusted return, America has a lot of positive things going for it. That probably means we'll try to continue to see other ways of having exposure to the US. And probably if we're not able to do that, maybe because of sort of more of an American first mentality, we'll then have to really try and work out other destinations for some of our capital. I think you also think about two other things which are very important to us. So one is, it's not the new deployment of capital, it's what you already own down there, which actually how do you make the most of those businesses in terms of maximizing their value. And secondly, we're very, very keen ourselves as an organization to invest in companies not only to get a return for our members, but to get do it the right way so we improve those businesses as we own them. So to be a good custodian of the asset, making sure it's a better business when we sell it. Now, if that's not possible because we have a different outlook to some of the American states, then that might be problematic for us.
And are we going in that direction, to your mind?
It depends what we're investing in. So I would guess if we say we're investing in something around healthcare, that might be a little bit more controversial than trying to help on electricity, power and transmission, which I don't think is that controversial, but there is clearly a need in the US for more power to serve the growth in demand from data centers and other activities.
What about sort of regions like Asia, India in particular, China, for example? I mean, with this America First stance, what does a money manager do as a global investor? I mean, if you're in one country, if you're an Indian investor, and mostly you can only put your sort of money in India or in the US for that matter, it's different. But you have money everywhere. How does this change things for you, especially with regards to Asia and India?
Sure. Well, we've been investing in Asia for a while. It was a deliberate decision to actually give us that access to higher growth, interesting markets where there's a lot going on in technology and sort of new areas as well as some of the more traditional fields. We've paused our investing activity in China. We did that a couple of years ago. We actually made that choice because we felt we couldn't necessarily see the growth in that market in the way we had seen hitherto. And also, from our point of view, we trying to compare what we could see as a new investment opportunity there with other parts of the Asian region even. I think it's very dangerous to see India as a substitution for China. It isn't. It's a different business. It's a different market. There are different businesses here. But what we do see here, I think, is a country which is, let's say, disappointed with 6% growth. I mean, I'd be delighted with that in Canada at the moment, to be quite honest. But it also has a very supportive government for inward capital like ours. It has a stable and growing economy. It has the right currency in terms of it being stable to the Canadian dollar, which is one of our other considerations. And we've made co-investments with the Indian government in things like the National Infrastructure Fund, where it's allowed us to navigate what's actually coming up as investment opportunities in the near future. So we've invested in a number of toll roads as well as hospitals and other growing sort of tech businesses in the region, and they seem to be performing very well.
Just one last point with regards to tariff, and then we'll move on to what you're doing in India and where you see opportunities. The common refrain is that tariffs are bad, and it's going to be bad for trade, bad for markets, etc. But 2 points. One, if everyone lowers tariffs, it is good for trade, globally. If reciprocal tariffs result in lower tariffs for everyone, everywhere, that is one. And second, some of these policies which the US is pursuing under this new administration seems to be firing up, we got to do it for ourselves kind of a sentiment as well. I mean, what you're seeing, what's happening in Europe, for example, Germany, countries wanting to invest, spend more, break out of the sort of, fiscal limits, etc. Canada, I think you briefly spoke about, there's increased sort of, people are rallying around doing more for Canada, in Canada. I think those things are happening in Asia as well. In places like China, etc. Do you think, that is one, it could move in this direction the way I'm sort of describing, or you think it's maybe convoluted and it is bad, it's all bad? What's your sense?
I think the bad thing about the current discussions from trade and tariff perspective is just the uncertainty. When you're not sure exactly where you're going to end up, it's quite hard for a lot of businesses we would potentially invest in to know how they're going to grow and deliver that return for us as a long-term investor. The second thing I'd say is around the tariff scenario is, as you rightly point out, it can increase that tit-for-tat type of nationalistic sentiment in terms of reacting to what could be, as you say, perfectly balanced trade discussion. It's probably better, in my opinion, to be framed through a trade discussion than actually, an arbitrary number that is actually being debated. But from our point of view, honestly, I go back to my earlier point. We try to stay reasonably apolitical. We would like to be able to find businesses that can plan for the future and not be particularly impacted through tariffs being implemented on them. And, I think the businesses that are probably finding it most difficult at the moment are manufacturing companies, particularly where they have subcomponent parts passing cross-border, where it's then quite difficult to know what exactly is not only the end tariff cost, but how you document for it.
Got that. Joe, what we're going to do is take a quick commercial break here, come right back, and we continue our conversation and focus on what you are doing in markets like India, what you like, and which of the sectors you find opportunity in. Stay right here. We're going to take a break. See you on the other side. Welcome back. We are in conversation with Joe Taylor, CEO, Ontario Teachers Pension Plan, one of the largest global institutional investors, nearly $200 billion in assets under management, and of course, over $4 billion right here in India. Joe, we've done the global macro, the big stuff. Let's talk about what you're interested in doing here in India. Infrastructure is an area of interest. Healthcare, you've invested in one of the largest private hospital companies in Maharashtra, right in the state. Technology has been an area of interest for you. Talk to us a little bit about your experience of investing in India and where are you seeing opportunities?
So our approach to India initially was to work out which partners would actually be the ones which we could trust to help us navigate a country we'd been impressed with for a long time, but really want to make sure we can make the best choices. So the National Infrastructure Trust example with the government was a really good one, helped us to really reflect on what infrastructure assets are coming up for sale. We also have a co-investment on another trust that actually gets access to privatized road that are coming out for auction. In terms of our private equity activities, we've been quite selective. The Seadri hospital chain is a good investment for us, and we're able to scale that with further capital and further support. And really that model is to really be expert in its particular location, because it then gets the best out of having really good doctors, the right referrals, and able to help and support the patients in the right way. The technology side's really been in our younger business, what we call Teachers Venture Growth. These are high growth young companies aspiring for the stars perhaps, but certainly aspiring to be able to be attracting retail investment maybe through the listed markets eventually in its life. So then back to your question, well, what else might we start thinking about? I think at one level we can certainly scale our investments on the private equity side. We've done a lot of investing in financial service businesses, and there's lots of interesting examples of those in India that we could certainly have a look at. On the infrastructure side, the asset or the relationship I haven't mentioned, which has been a fantastic experience for us, is working with the Mahindra Group on their sustained solar business. And again, that maps very well, I think, to the power need within India, and working with a partner that's actually receptive to long-term capital like us and has worked with international investors before. So it's probably going to be a mix of picking strong partners, sometimes family offices, working in sectors that we know and we understand. I guess the question which we are probably exploring at the moment within India is things like manufacturing businesses, where I think there's a big opportunity here. I think for India, as much as any other country at the moment, there's a bit of a question of what is AI going to do to the workforce. So for a country where I think job creation is a really important component, what will AI do? Will it actually negate some of that opportunity, or will it actually allow some new jobs to be created in more technology fields?
And just one question, Joe, I wanted to ask is, so private equity, venture, infrastructure, right? I mean, three broad kind of categories. What about public markets? Or is that, I mean, does your mandate allow you to do public equities, listed equities?
So we can invest in listed equities. The team we have on the ground, which is the team I'm visiting today, they're mainly focused on our active private situation. Those are the ones I've just listed out. I think the challenge more recently for an active private investor is actually keeping up with listed equity benchmarks.
Right.
If you look at the S&P 500, it's been growing by 20-ish% last couple of years. So you apply a illiquidity premium to that, you're really looking at making at least a 25% return, which is really tricky. We also would look at listed markets and say, quite honestly, the entry pricing for some of those businesses looks quite strong at the moment. So the question is, can we find better pricing, better growth opportunities in some of these other areas? And that's really the job of the active private team. What we also are able to do with our private assets is add some value. So we have a lot of effort we put into improving the business, as I referred to earlier, helping it to be able to be consistent with climate transition and other targets we've set for the plan overall.
So healthcare is one area. Continued area of interest, would you look at more assets?
Yes, we would. I mean, healthcare is definitely a sector that we like.
Hospitals, largely. I mean,
well, it could be that, but there's a lot of drug manufacturing that happens in India as well, where I think that could be potentially one we would have a reflection around. I mean, the obvious thing about hospital is we're already doing it, so it can either expand through that asset or find other opportunities of a similar nature. I can give you a very coherent plan for India, but the honest truth is, to some extent, you react to really interesting companies that become available and actually fit where we actually have expertise. We try to stay to something where we have some domain knowledge rather than going into areas where we're really not familiar with it.
And the other one is financial services, right? These are lending institutions, largely, primarily?
Well, we've done one in the past, a business called Spandana, which actually did lending to more rural areas and rural communities, and that was a successful investment for ourselves. And we did that with Kadara, one of our fund partners.
Right.
We would do something similar to that again. I think we want to be always thoughtful that actually, if it's a lender, what is the effective interest rate for the third party? Because if it looks usurious, that probably doesn't sit with our own values and our own reputation.
You said you probably will do one more. Is that what you said, Joe, if I heard you correctly, on financial services?
I think we can do as many as we find. I wouldn't want to rule it into boxes into saying it's only one. I mean, back to your comment, about $4 billion for us allocated to India is not something where we're constrained. So actually, the issue for us is having the discipline to make sure we pick the best opportunities and play to the strengths of the team. And if we can do that by cross-referencing it with good partners, then that's the ideal.
Is there a number that you aspire to, I mean, put to work as a percentage of overall assets, or you think as you said, I mean, you just go with what you find? I mean, in terms of you find a good asset, you invest. I mean, there's no target in that sense, or is there one?
That's one of the most often questions I'm asked around the world about what's our intention for certain locations. I probably try to answer it this way, which is to say, the danger of giving a team a capital allocation target is they go and spend it. And what I'd much rather do is just pick the best investment opportunities you're able to originate. And if that means there aren't too many because you don't like the look of something from a pricing or growth point of view, that's absolutely fine for us. We have a very strong current portfolio, and we only want to add in companies that really will add to that mix and that return.
When you said manufacturing, you mean capital goods, electronics, or you meant pharma manufacturing? I mean, what did you...
Well, I think it can be pretty broad. And also there are some great families in India who do specialize in manufacturing, either as one of the sleeves of their overall activities or the core business. And some of those businesses aren't necessarily located here in Mumbai. They're in other parts of the country. So one of the issues for us will be inevitably, if we want to look after that business in terms of trying to be adjacent to it, able to add value, we've got to be a little careful it's not too far away from our current team.
On the venture side, how's the experience been for you?
To date, it's been fine. You know, we have 3 assets that are performing well. They're very much moving towards being able to attract subsequent capital from ourselves and from others. Generally, the sort of businesses we like are ones that provide good cost-effective solutions for larger entities. So we have one, Tariffs, which actually is very good for banks in terms of automating their know your customer and other regulatory type things. That's a SaaS software model business. It's something we understand from what we've done in North America. Looks like a great company, and we're happy to be now part of the shareholder base.
Absolutely. Just last one question, energy, right? I mean, where does one go there in terms of energy investments? It looks like, coal is very much here to stay in emerging markets, especially in countries like developing countries like India, et cetera. But maybe now even in the US, so there's a bit of a pushback to renewables and green energy, et cetera. Again, do you think it's a bit of a temporary thing? How would you look at investing in energy assets?
Well, two observations. We have made clearly a commitment to reduce the carbon intensity not only of our own business but our investee companies. So we're able last year to hit our 2025 target a year early, which was to reduce those emissions by 45% from where we started in 2019. We would look at coal as honestly something we're generally at the moment helping power generation companies and other businesses to sort of reduce their exposure to, rather than trying to increase our allocation to it itself. We do a lot of renewable investment activity around the world. A lot of that is actually electricity transmission rather than necessarily power generation. We have, as I said earlier, the Mahindra Sustain business here doing solar, which is part of the power solution potentially for India. But I think transmission could be something for us to think about within India as we go forward. There's also a lot of businesses, back to your question about manufacturing, who make subcomponents for transmission. So if you take some of the key elements that you would want to have in a transmission business, there's quite long lead times in getting access to those component parts. And if they're made here in India, that would be interesting.
Wonderful. When's the next trip, Joe?
I would like to come back as often as I'm welcome, and it looks like it's a date that's certainly been very much on offer to us by both our local partners and the government here. Most of my offices, my plan was to see them every year, so you might either see me at the end of this year or early next.
Joe, you're always welcome to Mumbai, to India. We look forward to your next visit. Wonderful conversation today. Thank you very much for your time.
Thank you.
Thank you.